to another edition of Built to Sell Radio. My name is 𝙎𝙀𝙊𝙀𝙍, and this is the show that helps you punch above your weight when you negotiate the sale of your company. And today's edition is a unique one. It's called Built to Sell Intel, where I break down 4 previous episodes of Built to Sell Radio and try to draw out the transferable lessons for you, the things that struck me in doing the interviews that I think you could take away and learn and put to good use. So this is 4 stories, and it's also an opportunity for you to ask questions. We do this live, and so if you're listening to this on the recorded version, there's an opportunity to actually join live. And when you join live, you can ask your own questions. So if you want to join live next time, all you need to do is opt in at 𝙬𝙊𝙇𝙇. There's a little button that says free gifts. Download those, and you'll be automatically invited to each of our upcoming editions of Built to Sell Intel. You can join the live studio audience, ask whatever questions you have, and that's a big part of the show for us. So I hope you will join us over at 𝙬𝙊𝙇. Just opt in and we'll get you an invite for the next episode. But right now, I'm going to pass you over to my colleague, Jeremy Weiss, who is going to take us through as the host of Built to Sell Intel. I'll see you on the other side. Welcome to another edition of Built to Sell Intel. I am joined by my esteemed colleague, Jeremy Weiss. Jeremy, take it away.
I'm excited, and if you haven't listened to these, you should go back and listen to all the Built to Sell Intel, because we recap some of the biggest takeaways from Built to Sell Radio. And, you know, John asked the questions, but in this one, he gets to overlay his thoughts and advice on the episodes. And if you don't know John 𝙬𝙊𝙐𝙍 is the founder of the Value Builder System, which is a practice management software that helps business advisors automate their processes to win and keep the best clients. And the Value Builder System incorporates several diagnostic tools, including the Value Builder Score. It's offered by a global network of certified Value Builders advisors. And John, I always like to say the businesses that achieve a Value Builder Score of 90 or greater are worth double the average performing business. And you can go to 𝙬𝙊𝙇 and actually take your Value Builder Score on their website. He also has the best-selling book, Built to Sell. There's many people who come on, John, that go, I sold my business. I remember reading your book to help prepare, build the value of my business, and then eventually sell. So it was recognized by Fortune and Inc. as one of the best business books. And he's also, obviously, you can listen to Built to Sell Radio. He also has a book, The Automatic Customer and the Art of Selling Your Business, and check that out. I also want to point people to, so 𝙬𝙬𝙇.com/radio. You could also go to 𝙬𝙬𝙇.com/SOP to get an SOP ebook. So I wanted to start with the episode with Ben Kelly. And Ben Kelly kind of went from Elon Musk to exit, and he got
First person I've ever spoken to who actually works for Elon Musk. I think this is a pretty cool story.
I felt like he treaded lightly on that. You know,
I asked him at one point, did you hear what I said? Like, what's it like to work with Elon Musk? And what was his response? He said something like, let's just say he gets the most out of his employees or something like that.
Exactly. So he left SpaceX to start the launch company, where they supply hardware parts and consulting to a growing list of new aerospace companies like SpaceX. So in less than 5 years after starting, they were approached by Voyager Space, a private equity-backed group, and he sold a majority stake in the launch company. And he also, I think, was living in Alaska in general. So what did you like about Ben's story?
Oh, a bunch of stuff. So, I mean, one of the things I thought was really cool, and we should just let people know, Jeremy, since we're doing the live episode, we've got a bunch of people who have joined. I can see all their names. Hi to everybody. If you have a question you want to ask about any of the episodes, drop it into the GoToWebinar control panel in the questions tab, and we'll endeavor to get those answered along the way. If you're listening to this on the podcast version, make sure you join the live version, because that'll give you a chance to ask any questions that you have. Just go to 𝙬𝙬𝙇 and opt in, and you will be invited to the live version. Ben was cool. So yeah, so a couple of things about the Ben story that struck me. You know, he's in the space industry, which is obviously very expensive. That's probably the understatement of the world to get into. And he started his business for like $1,200. He left SpaceX, had a bunch of student debt from getting a bunch of degrees in engineering, And so he started the launch company with $1,200 and didn't have a lot of money, obviously, to finance any sort of product that he could build. And so what he did was offer consulting, and he went all, there's a lot of emerging space companies that are kind of coming on stream. Obviously, SpaceX, the Jeff Bezos one, the Richard Branson one. There's a ton of them that are kind of emerging, and so he started offering consulting, selling his time. What he did, which was really cool, and what I would recommend anybody do that is trying to bootstrap a product company to get to to effectively get enough cash to launch, is he retained the IP for his consulting. So he said, sure, you can hire me as your consultant, but whatever we develop collectively, I got to own. And that was one of the kind of keys. He took what he learned from doing this quick disconnect product for one of his customers and basically retained the IP and then sold it to all the other space companies he was working with. And that's one of the things that I thought was kind of novel and enabled him to kind of build up his business without necessarily selling a lot of equity or finding other ways to finance it.
Yeah, I love it. It seemed like he listened to his customers along the way. They were asking for some, solutions and also hardware. It seems like hardware would be a tough space to do,
Exactly right. And again, I think every service business wants to be a hardware business, or every service business wants to be a product business. The challenge is, like, how do you get the money to go build the product, to test it, design it? It's obviously prohibitively expensive for a lot of folks. So he found a way to thread the needle, and he said, look, I'm going to retain the rights to the IP. I will do the consulting on an hourly, daily basis or whatever, but at the end, the product we come up with, I get to own. And not all clients are going to agree with that. But I asked Ben, like, how many of your customers agreed to that? He said, look, we were in a hot space, so they didn't have a lot of choice. And so I was able to retain that. So it's not possible, I think, in all your agreements. There's a very famous old ancient example now where Bill Gates was hired by IBM, and the deal was he would effectively build the first version of Windows for IBM, but he retained the rights to the IP. And so, I mean, there is a history here of folks doing that. The other thing that I think was really novel about Ben is he's a young guy, as you point out. He's very proud Alaskan and has a young family. And he got to a point about a few years after starting the launch company where he kind of wanted to solidify his financial position. Again, he had a bunch of student debt from, he took 2 engineering degrees. He wanted to solidify where his family was at. And so he sold, I think it was 60% of his company. After I spoke with him, it was a 60-40 deal. Like 40% he retained. It was acquired by a private equity group. Now, private equity there's lots of challenges associated with selling to private equity, and I've done more than my share of layering on the negativity on the show. But what I do think is really important for folks to know is that if you're feeling that just uneasy about how much of your net worth is tied up in your business, these deals can make a lot of sense. Basically, the deal was, we're going to buy 60% of your company, and you're going to roll your 40% equity into a new entity that you're going to have shares in. So you get to put some money in your jeans. He effectively kind of solidified his family's financial situation. Probably won't ever have to work again, or certainly will have that choice for many years to come. But he's also got skin in the game. He's still a young guy, so he's still, got 40% of his equity in shares. And so I think for him, just given his life stage, that was a neat option. So I think that was the other thing. And the third thing that I took away from Ben Kelly was just his humility around not being a manager. He reached, I think, Jeremy, you remember, was it about a dozen employees?
Yeah, it was about that.
But 12 companies. So this is not Tesla, right? This is not a huge company.
It was surprisingly low amount for a hardware launch company for aerospace.
Yeah, I was blown away. I'm like, 12 guys in an Alaskan, barn or hangar somewhere, and you built this company, and that's exactly what he did. What I think he was really humble about is acknowledging that he is not a manager at scale, right? And I think if we're honest with ourselves, very few entrepreneurs really are. We could all point to examples, Elon Musk or Jeff Bezos, people that have both started companies and been able to build them into significant enterprises with tens of thousands of employees. In Amazon's case, millions of employees. That's rare. I
Different
think
skill set.
many more
Yeah.
entrepreneurs that I've seen, I know, Jeremy, you've interviewed a ton as well, they're really good at the starting phase and maybe up to 10 or 20 kind of folks. But there is a point where, you know, you have to shift from entrepreneurial, figure it out as you go, to kind of more formalized management. And that's not for everybody. And I think Ben had the humility to say, I'm out. Like, I don't want to do that. That's not what gets me out of bed in the morning. And I think some of us go beyond that point where our sell-by date is beyond us, where, you know, we're beyond our point of sort of being effective in what we do. And I think Ben had at least the humility to pull up and say, you know what, I'm out. I'm beyond that point.
I have a question on that. If people have questions, please put them in the chat. We will get to them. But piggybacking off that, John, you mentioned the private equity. What are some things people should watch out for when working with private equity or thinking to be purchased by private equity?
Yeah, I think you first of all just have to be really sober-minded about what private equity does. Private equity is a financial organization. Typically, they've got investors who are looking to get a return, and so to get that return, they effectively need to put a little capital at risk and get as big a reward as possible. And so, how do they do that? Well, they first of all aren't generally going to buy 100% of your company. They're going to buy a slice of your company, hope in many cases the majority of it, but they're going to leave and get you to leave enough in so it hurts. In Ben's case, I think it was 40%. So that you're not going to want to walk away from that, because they don't have generally management teams in place. They're going to ask you to continue to run your company, and so then you're effectively at their mercy, if you will. You've got enough of your equity in the business that you don't want to walk away from it, yet you don't control the company anymore. And so I think you really have to be really sober-minded about what it is they're trying to do and where they see the synergies. Like, they're going to, you have to assume that they see something that you don't see, or they wouldn't want to buy your business, right? They see some way to make it more valuable in their hands. So either they think you're doing a crappy job of running it today, which is, I think, the minority of cases. The majority of time, they think that by stitching you together with other businesses, they can take advantage of some synergy. So the question would be, like, what do you see as the upside? Like, what's the play for you? And listen for, well, we're gonna gut your staff because we think you're a bloated company. Well, that's probably not a deal you want to do, right? Or, we want to buy 3 other companies like yours and take advantage of economies of scale. That might be a better story. But I think you just have to be really clear-eyed about, like, what is their business case. They're not buying your business to hold it for 50 years. They're buying your business to flip it effectively in 5 to 7 years usually. And so you need to understand what's their effectively investment thesis, which is kind of fancy talk for, like, why are you doing this?
I love that. So then people will have that conversation with them in that courting phase to kind of find out.
Yeah, absolutely. Like, where's the synergies here? Where's the strategic value you're trying to unlock? Why is it that you're going to buy my company for, let me just throw out a number, 5 times EBITDA? Like, what do you think you can sell the entity for downstream? Oh, you think you can sell for 10 times EBITDA? Well, how are you going to get double the multiple? Like, why would it be worth twice in your hands? Well, we're going to make it bigger. Okay, how are you going to make it bigger? Well, we're going to stitch you together with other companies. Well, will that make, will that dilute my, shareholding, et cetera? Will I have to work with those other owners, and who's going to stay on? Like, there's all these questions you want to ask if you're really trying to get clear on, like, what do they see as the play? Right? Because they're not buying you for 5 times earnings to go sell you for 5 times earnings. Let's be clear. They're buying you for 5 because they want to sell you for 10, 12, 14 down the road. So you need to say, well, what is this that you are going to do to make my company worth not 5 times, but 10 or 12 times? And that's a really, I think, important question to get underneath.
Yeah. And, the next interview we're going to talk about, Josh Delaney, actually, he talks about that in the interview and touches on that. So definitely watch that. Before we get to Josh, a question from Jack. And Jack, and again, put your questions in the chat so we can answer them. Jack says, if I want to sell in about 2 years, what are the most important things now I should do to maximize my value?
2 years is an interesting time frame because it's really not enough time to change and revolutionize your business model, right? Like I could say stuff like, oh, you should create a recurring revenue stream, or you should make sure you're growing. Those things take time to bed in. First of all, you got to design them, or and it takes time. So I think, Jack, in your case, uh, you probably want to stick with your existing business model, but you may want to start to fine tune some of the things that you're doing today. So obviously, if you're involved in doing any of the selling still, Jack, you're going to want to necessarily pull yourself out of that, hire a sales manager, hire sales reps, etc. It's usually the rainmaker job that is most business owners get sucked into, which you've got to find other people to do the work. So I think it's enough time for you to train a sales manager and bring them in so that they're running at least the sales organization. You're going to want to think about how you position your company, Jack. So again, what I've seen is that acquirers will typically have shortcuts. They'll have an investment mandate and they'll use shortcuts to find companies like that. So they'll say, oftentimes private equity companies, they'll say, okay, in the case of Ben, they were rolling up space companies. So if Ben had held himself out there as a engineering consulting company, they would have completely missed him, right? Because private equity companies use Google just like the rest of us, and they're Googling, well, who are the space companies out there? And so again, Ben made the strategic decision that even though he was effectively an engineer for hire by the hour, by the day, a simple consultancy, he called himself the launch company and focused on aerospace and space in general. And that got him on the radar screen of the private equities company. So Jack, for you, I'd be asking myself, like, in your sort of general industry, what are the types of companies that are being acquired? And then make sure you sound like that in your public facing statement. So your website, your storefronts, your signage, all that stuff, you want to sound like a company that they would want to buy. And again, some of those semantics sound superficial, but I think they're really important when it comes to like a 2-year time horizon.
Yeah, no, I love that, to like sure up the positioning, because that's going to be huge when it comes to someone looking at you. The next one, John, was Josh Delaney, and Josh Delaney started FAB CBD, which is CBD e-tailer, and he was kind of early to the game. It was in 2017, and actually his mom was his first customer, and by 2020, through a combination of marketing and the uptick of CBD and that industry, he rose to more than $10 million in annual sales. And in early 2021, High Tide was in discussion with High Tide, which is a Calgary-based cannabis company, offered him $13 million in cash and $8 million in High Tide shares in return for 80%. So I'd love to hear what you liked about Josh Delaney's story.
I don't know what it says about Josh that his mom's so stressed out that she has to be his first customer. Bringing up Josh may have been a tough chore. I'm kidding. CBD oil, of course, is the derivative of the marijuana plant. I think it's supposed to make you relaxed, but it doesn't have the narcotic effect of.
It doesn't have THC typically.
Yeah, I think that's
maybe.
That's the essence. At least that's what my buddy told me. And I think it's an interesting story. One of the things I took away personally was a real education in affiliate marketing, which Josh is an absolute expert in. Affiliate marketing is when you find an influencer or someone with an audience, a blogger, a social media influencer, and say, look, I'll give you a piece of the action here if you promote my product. And in Josh's case, he had a very high margin product, which was really good because it enabled him to pay rich incentives to his affiliates. And so the way he described it to me on the show was that there are sort of two types of affiliates. One are sort of one-time payments, and the others are evergreen. And there's a word that I've forgotten the name of it. You might recall, Jeremy, but it's the lingo in the affiliate marketing space. But effectively, it's evergreen versus one-time. And he was describing that in some cases, you could pay your affiliates more than 100% of the total order value of the first order, because what you're getting obviously is the customer information and the tail. And for folks who use CBD oil on a regular basis, obviously they're not buying it once, they're buying it regularly. And so you could have a situation where you would pay such a high bounty to that affiliate that it would actually exceed the entire order value. The other side is where you kind of become more partners with your affiliates and say, look, we're going to pay you a smaller percentage, 10, 20, 30, 40%, depending on your margins, but we're going to do that forever. So as long as that customer buys from us, we are going to continue to share. So, and that's the model that Josh used. And again, that was his decision for a lot of reasons. And again, part of it was that the revenue was a tail and they wanted to partner with their affiliates and have that kind of close relationship. But it was a real education for me in affiliate marketing, which I did not know much about. And he really demystified it for me.
Yeah, I mean, it was interesting because he was really generous. I mean, they gave him a portion of the first sale and then a percentage of all ongoing sales. So if I'm an affiliate, I'm like, cool, I'm going to keep promoting this because after that first sale, I don't have to do anything. The company handles everything, but they know that builds that long-term collaboration. So I'm going to, keep promoting that company.
Yeah, and look, Josh made the point that your reputation is everything in this space. The affiliate marketing space is very, very small. Your reputation gets around if you don't pay commissions or you're late or you're whatever. It is very easy to get kind of caught out. So he wanted to be very above board and really be one of the gold standard people to partner with in the affiliate space. So that was good, and it also really, I mean, Josh is a marketing savant. I mean, he's a very, very smart guy, and so he was able to grow this business very, very quickly. And as we know, one of the big drivers of the value of your company is your growth potential, like how quickly you have been growing in the past, and even more importantly, to some extent, is like how quickly does your acquirer think you could grow in the future? And affiliate marketing is one of those, like turning on a tap. It is very effective when you do it right, if people have a loyal audience. So I think he did some great stuff. I think there's a couple things in the deal mechanics that are really interesting in Josh's story. One is that he took about 40% of his proceeds in the stock of his acquirer. And so, that can be a dangerous play. But I think Josh went in with his eye. I mean, he's a very savvy guy, so he went in with his eyes wide open. For folks who are listening to this who may be thinking about taking some stock in return for their equity stock in their acquiring company, there's a few things to think about. Obviously, the key question is, well, what's the liquidity of that stock? Do you have the rights to sell it? And is it a publicly traded stock, for example, or is it a privately held stock? Well, if it's a privately held stock, you're getting the minority in a privately held business. It's really not liquid, and it's very difficult to ever sell unless you have a put option. And that's one of the things that Josh included in his deal. Even though High Tide was a publicly traded company, he had a put option. What is a put option? A put option is where you have the rights to effectively put your shares onto the acquirer at a predetermined price. And so you can say, look, I'll hold, in Josh's case, he said, look, I'll hold 20% of the equity in this deal. So he decided to hold 20% of the shares, but he negotiated a put option, which is, look, if I ever really want to just pull the trigger and get out completely, we agree up front that this is the price that I can put my shares onto you, and you are obligated. You don't have the rights to, but you are obligated to buy them. That's a put option. It's different than a stock option. It's a put option, if you will. And that's what he negotiated. And again, I'm not a lawyer, so talk to your lawyer, but if you want to execute on any of this stuff, don't take my advice as legal advice. But I think that was a really interesting kind of interesting way to structure a stock deal. The other thing that I would sort of caution you around is that when you sell your company and you take stock, obviously you don't control that company anymore. And that can be uncomfortable for a lot of entrepreneurs who, let's be honest, many of us are control freaks, right? I would put myself in that camp, so I say that in a loving way. But we want to control everything. And so when you don't control the price of your stock, it can be very unnerving. Like in the case of Josh, I just looked it up before this call because I wanted to make this point. High Tide stock, in the time that he's owned it, about a year, it started, I think it was around $5 a share when he accepted 40% of his shares for that. It went all the way up to $15 a share. So effectively tripling the value of that tranche of his equity, right? In July or June or July, and now it's back down to $5 a share. And I don't know if he had the foresight to sell when it was 15. I really have no idea, or if he had the rights to it.
That's my money. Yeah.
Yeah, that's kind of beyond the point. The point is these things kind of can gyrate, especially if you have a small company. And so one of the things that Josh wanted to make sure, when I pushed him on this, I said, why did you take so much of your deal in stock? Wasn't it? He said, one of the things I made sure of is that the trading volume of that stock was high enough that I could sell without tanking the stock. And when you've got a very thinly traded stock, in other words, the trading volume is very, very low, and you're a significant shareholder, and you rock up one day and say, you know what, I want to sell my shares. The fact that you want to sell your shares in and of itself will drop the price of the share if the trading volume is very, very thin. So that's another thing to look out for if you're thinking of taking stock in a publicly traded company in return for your company or a portion of your company. Figure out the trading volume and make sure that when you sell those shares, just the fact that you're selling isn't going to tank the stock.
Yeah, I mean, John, you mentioned in the last interview we were talking about, Josh really believed in the trajectory and the philosophy and the strategy to growing the company. And so I think for that 40%, he was like very optimistic of the way where they bought him for X. He kept mentioning throughout, like, this was super fair. This was really fair. He kept mentioning fair, that he saw, well, they're buying me for X, but their stock is worth X amount of times that as soon as they buy me anyways.
Yeah, there's the kind of accretive piece of this. And again, accretive deals are where the publicly traded stock is trading at X multiple, and you are trading at a percentage of that multiple. Let's say, for just round numbers, you have a publicly traded stock that is trading at 20 times EBITDA, as an example, and they buy you for 10 times EBITDA. Well, they can effectively graft your profitability onto their P&L the next quarter they report, and all of a sudden, in their hands, your profitability is worth 20 times EBITDA. So
Right.
they kind of can't lose in that situation. If your profitability is stable and buying you isn't going to call into question their overall valuation, which is unlikely unless you're a massive company, they just basically graft your profitability onto their P&L, and they get a lift if they buy you for a lower multiple than they're trading at. And that's another thing that Josh took advantage of.
Yeah, thanks for pointing that out, because I thought that was fascinating. Like, it's a no-brainer for that company to purchase. It's
Right,
also a
kinda
no-brainer
can't
for
lose.
Josh. It's a win-win.
Yeah.
So put your questions in the chat. I'm gonna ask Susan's question, and Susan asks, what are some mistakes that people make, and what is the best way to structure an earnout?
Oh, Susan, you should listen to the next episode, because our next story, the third of four today, is with Prantik Majumdar, and he talks a lot about earnout. So I don't want to steal his thunder. When you're structuring an earnout, Susan, what you want to make sure is that achieving your goal is in your control effectively. So the classic way earnouts are structured are that you will get some of your money up front and then a portion of it paid over time, tied to the future profitability of your company. The challenge with profit as a metric is that it can be interpreted. It's subjective, believe it or not, by accountants, and you don't control their interpretation of profit, right? So when you sell to a big company with its own accounting department, they get to decide how they want to interpret your profitability. And there's very little control unless you contemplate that in your share purchase agreement. It's very little control you have over profitability. And so, Susan, I just encourage you to think about if there's other ways, other metrics you could tie your earnout to. Like, even revenue is more objective. It's hard to argue if you were achieved a revenue threshold. So, Susan, I don't know what industry you're in, but if you can tie it more to revenue or top line, that might give you just a little bit more control.
I see.
Hope that helps.
Yeah, so if it's like tied to profit, and if the company decides to take on a bunch of expenses, you have no control over that situation. So yeah, I love that.
Yeah.
So let's talk about Prantik. Prantik and his business partner built Happy Marketer, which is a digital marketing agency, to more than $10 million in annual revenue before they decided to sell to Dentsu. And they agreed to sell for around 7 times EBITDA, 40% of which was paid up front, with the remainder available in a 4-year earnout tied to the future profitability of Happy Marketer. What did you like about Prontique's story?
Well, let's talk about the earnout because Susan raised the question, and I think it's a good one. It's one of the points I was going to make, anyways. Yeah. So this was a digital marketing agency, and if you know anything about marketing services companies, they typically sell with a pretty big portion of the deal in an earnout. So this was not unique. Again, 40% paid up front, 60% tied to a 4-year earnout. And again, a lot of people hear that and think, "Oh my gosh, like I would never sign up for that." And if that's where you want to, be, you really need to structure your agency or your marketing services businesses so that it can really run completely independent of you. Standard operating procedures are going to be a big part of that. There's a Built to Sell radio episode with 𝘎𝙁𝙊𝙇𝙇, who you might like to Google. Just Google Built to Sell Radio 𝘎𝙁𝙊𝙇, and you'll hear how she structured her agency so that she was able to get out without an earnout. But it's really rare, and it's going to mean that you've got to basically create these standard operating procedures. That's one of the reasons we wrote the ebook, by the way, is to give people a sense of how you can create these standard operating procedures. But it's still going to be tough, I think, in marketing services. So Prontique's experience, where 40% of his shares were paid up front, and then 60% are tied to an earnout, I think is pretty normal. One of the things that Prontique did a great job of, though, and this goes back to Susan's question, is he negotiated the cost structure that he was signing up for up front. And so he went into this deal with his eyes wide open and said, "Look, I don't want you guys to graft your fancy office space, your all of the kind of bloat that you have as a big company." He was bought by Dentsu, one of the largest advertising holding companies in the world. "I don't want you to start grafting those expenses onto my profit and loss statement." And so he negotiated his cost structure, everything down to like what he was, going to pay for office space, salaries were in his discretion. The software that they used, he went down to that line item saying, like, this is what we're going to pay for each of these different things. So he kind of locked in his cost structure. And so again, if you are having to sign up for an earnout, which again is almost always the case in a marketing services business, most services business in general, I just want you to think about how you might maximize your control of that. One way to do it is through tying it to top line revenue, because it's less subjective. Another way is to negotiate upfront your cost structure, and so you've got a hard cap on what you can be charged for certain sort of internal expenses, if you will. So that's one thing I took away from Prontique. The other one, Jeremy, was back to your introductory points. He talks about, Prontique did a great job talking about optics and why optics matter when you go to sell your company. And we talked about this with Ben Kelly as well. The first example where positioning himself as a sort of space company helped him attract the attention of a private equity company. In much the same way, Prontique really wanted to avoid the discount in valuation associated with a typical, marketing services company that's focused on execution, which in their space can be pretty low multiples. Like if all you're doing is, writing email copy and creating brochures and doing the kind of, basic tactical stuff associated with marketing, it's not uncommon for your valuation to be sort of 3-4 times EBITDA. Yet what he was also doing was consulting, similar to like an Accenture, where they were doing like digital transformation strategies, and that business is much more highly valued. That could be 7 or 8 times profitability. He was also reselling Google Analytics software and some of the training associated with that, which again attracts a larger multiple. So they, I think in the case of the software business, he figured they could get maybe 10 times EBITDA. I think the training business, he was kind of benchmarking around 7 to 8 times EBITDA, and the marketing execution business, which they still did some of, he was thinking kind of 3 to 4. And so we wanted to make sure that when he went to market, he wasn't being discounted as an execution company. And so they went hard in positioning themselves as a digital agency driven by data. And and again, the common stereotype a lot of people have when you think of like a marketing agency is like, Mad Men, where you go out for like 3 martini lunches and you buy TV advertising. And so he was really desperate to say, no, we are not that kind of agency. We are heavily data driven. You're more likely to find our employees with a science degree than you would be an arts degree. You're more likely to find them taking math than you would English. And so he was very focused on being a digital agency driven by data. And they positioned him that way and ultimately got 7 times EBITDA. So sort of the higher end of what you would expect given the kind of messaging. So that was also really important, the way they kind of pivoted to that messaging.
What stuck out for me, you talked a lot about in the interview about them leveraging bigger names for credibility and attractiveness. I'd love for you to talk about that a little bit as well. I mean, I think Google, there was one other one that they really had a collaboration with.
Yeah, Boston Consulting Group. Yeah, I mean, look, when you're a small company, when you are, in Happy Marketer's case, they were startup, right? They ultimately got to 10 million in revenue, but they were in the early days. It was just 2 guys and a laptop kind of thing. It was not a significant business, and so they borrowed the brand equity in their partners heavily. So they partnered with both Google, being a Google Analytics reseller, as well as Boston Consulting Group. Boston Consulting Group, they were based in Southeast Asia, and so they wanted a presence. Boston Consulting Group wanted a presence there, and so they became effectively Boston Consulting Group's partner in Southeast Asia. Well, that has gravitas, right? That has brand equity. There's a halo effect to be able to say to the marketplace, including acquirers, look, we have strategic partnerships with Boston Consulting Group, which is a very prestigious brand among some people's eyes, as well as Google. And so they enabled themselves to sort of punch well above their weight from a brand perspective by partnering. And again, those partnerships were not sort of the back of the closet things they talked about only if asked. They were very prominent things, right? Like they were on their website. They talked about them in meetings with customers and potential investors. Like it was a big part of how they looked bigger than they are. So those partners you have can be assets, I think, in positioning your company as being more substantial, bigger than perhaps you are. The other thing Prantik talked about is being acquisition ready, which I thought was kind of cool. He, and this goes back to what we've seen as the 2 most common reasons business owners sell their company, or the 2 most common triggering effects, if it like the triggers that business owners that trigger them to sell their company. One is a health event, right? So they have some sort of medical emergency, either themselves or their spouse or a loved one, and they literally can't work, or like their mind is completely elsewhere, and so they must sell effectively. So that's one. And the second is that they are proactively approached by a potential acquirer. And this is happening, obviously, for a lot of our listeners more and more these days, because, of course, it's a very liquid M&A market, lots of private equity companies rolling up businesses, and so they're getting approached much more. What I find interesting about both of those scenarios, either a medical event or being approached by an acquirer, is that in both cases, you're on your back foot. In both cases, you're reacting to something else, as opposed to proactively positioning your company for sale, which is where I think you have the most negotiating leverage and the best outcomes. You're sort of reacting to something. And that happened to Prantik Mazumdar. In his case, Happy Marketer was approached by Dentsu, and they approached them early in their business. And to Prantik's credit, he said, "Look, we're just not ready." And he said, "Look, there are certain things we want to get done before we sell." And one of them was to reach $10 million in revenue, because they knew that would give them a bit of a bump in valuation. They wanted to reach 50 employees, and they wanted to have solidified these 2 partnerships with BCG and Google. And they deemed those 3 things as prerequisites for an acquisition. And it wasn't until they got those 3 things accomplished that they circled back to Dentsu and said, "Okay, now I think we're ready." But I think it's just worth remembering for anybody listening, the most likely scenario that's going to trigger you to think about selling, it is actually something that you don't control. It's either being acquired or some sort of medical event. And the more you can get ready in advance of that happening, the better. I mean, I don't mean to be morbid, but we're recording this in this horrible uptick in COVID, my wife calls it Omegatron because she's so sick of it, but Omicron, And I think I haven't got it yet. I'm just waiting for that day to come. But I'm trying to think about all the things I could do now to kind of get ready. It was like stock up the medicine cabinet with Tylenol, and like make sure I've got everything sort of ducks in a row for when it comes, right? Hopefully it never comes, but I'm sure it will. Same way for you preparing your business, right? Like if you can get your ducks in a row now, so that when that happy event comes where your big strategic acquirer approaches you and says, okay, we want to buy you, you're ready. You don't have to scramble for 6 months to kind of get ready. So I think that was another cool takeaway for me on Prontique's story.
Yeah, I mean, John, in general, I think humans are motivated more by pain than pleasure. So thinking of that morbid scenario is going to light a more of a fuel as opposed to sitting on the beach. So I don't think that's I like that way of thinking. If it moves someone into action to put the things in place they should be doing anyways, right? So questions from people. We have a question from Malcolm, and he said, if I'm only a 30-person company, have a flat organization, what senior leadership should I have in place to make it most attractive to a buyer, as well as obviously efficiently to run the business?
Yeah, Malcolm, great question. So you're going to want to be able to make a case to an acquirer that your company can thrive without you personally doing the work. And so that's easy for me to say and hard for you to do. Ideally, you've got somebody else driving the business top line. So you've got someone in charge of sort of sales, business development, that piece. If you're a direct to consumer, marketing is probably going to be that role for you, like demand gen. If you're a business to business, is going to be likely sales or business development. So having somebody who you can credibly hold up to an acquirer saying this person is really responsible for our top line revenue. That's going to be, I think, a key hire for you. Equally, someone that can build the product, I think, is another kind of key hire. So again, in a service business, that's probably like a head of customer success or a head of delivery in a consulting company, but effectively the person who's responsible for the end product. Again, in the service business, I don't mean product as in touch and feel, but product as in like what customers get. So having someone sort of oversee that, I think, is a really good piece. The one functional area that you can probably afford to skimp on is finance. And I don't mean skimp on in the sense of not doing good bookkeeping, because you're going to want to have good bookkeeping, but you can probably outsource that. You could probably bring in a fractional CFO or partner with a good accounting firm that can really sort of solidify your books. Realistically, most acquirers have decent chops when it comes to finance, and they're probably going to eliminate your CFO if you go hire one. They're probably not going to keep him or her in the role that they are in today. And so that's the one functional area. If you're Malcolm, if you're sort of, I think you said in your question, you're a couple of years away from selling. That's the one area that I probably would not invest heavily in. I would in a full-time person. I would instead invest heavily in sort of a fractional CFO, accountant, somebody who could be that person. But know that like once an acquirer comes in, they're probably going to blow that person out anyways, so it's better to have that person on contract, I think. But someone over business development, someone over like product delivery or design, I think, is another kind of key hire. And then the third role, if you can do it, is to bring in a president, a 2IC, a second in command, a general manager, someone who can really make sure the trains are running on time, integrating the various kind of functional areas of your company. That's going to give an acquirer a high degree of confidence that this business is going to keep going. And you may find that while they may want you to keep some equity in the business, you may be able to minimize that if you've got a president or a chief operating officer, and you can say, look, this, you need to incentivize the president of the company with some additional stock options or shares or some sort of equity, but you don't really need me around anymore. And so that happened. We did an episode. There's a great episode. The gentleman's name is escaping me right now. It'll come to me. But it's Built to Sell Radio, and the company is Dimple, and they brought in a 2IC and sold the business quickly thereafter, in part because the 2IC, the second in command, was so good. So again, you can Google Built to Sell Radio Dimple, DIMPLE, and that episode should pop right up.
It was Damian James.
Damian James, thanks. I'm getting old, man. I can't remember these names
Well, I looked it up on the site as you were talking, so
you were cheating.
yeah, I'm not taking credit for remembering that, but but no, thank you. That's really valuable, and it kind of goes into the next conversation with John Clayton, because you talked about the morbid reason, and there was some health stuff going on for John, which kind of preempted him to look at selling, and he started Streamline Marketing to help brands manage their affiliate programs. Taking full circle with Josh, but he bootstrapped his business around 30 employees. He avoided hiring some senior roles in favor of doing a lot of the work himself, but he had a lean approach, so the business had 50% EBITDA margins, but it obviously he was working a lot, and he had a shingles diagnosis, ended up in the hospital. And one of the things, most people think of shingles around their rib cage. He had it in his throat. And if anyone, I mean, I've not had it luckily, but I've heard it's really, really painful. And I can't imagine having it in my throat, because then it's hard to breathe. And so he ended up in the hospital, and he was stressed out. So talk about a little bit, John, about what did you like about John's story?
Yeah, I mean, it was obviously a very dramatic story, because he's such a young guy, 35 years old, and the stress of running his company the way he was running it, brought on this shingles diagnosis, and ultimately that led to his throat. And you're right, his throat began to close, and it became a life-threatening situation. And he was treated in hospital, and eventually it was in hospital that he realized, like, something's got to give here. And I think there's a lot to learn from John's story. It actually goes back to Malcolm's question, which is interesting. John built his company to 30 employees, and in his own admission was like super flat, right? It was like him and some doers, but there wasn't that management layer. And I think he did well to get to 30 employees. I mean, many entrepreneurs kind of run out of time of the day, bandwidth at 10 or 15 employees, maybe 20, if they haven't built the management team. And that's one of those big hurdles that a lot of people are like, you know what, I just don't have it in me. Like, if we go back to story number one, Ben Kelly, he reached 12 employees, and he was like, I don't have the chops to build out a management team to take this thing to 50. And so I think John was in a little bit of like no man's land, where he had 30 employees, but he was really focused on profitability. And so while he got the profitability he really craved, which was 50% profit margins, 50% profit margins, he didn't necessarily have the quality of life associated with that. So he was working all kinds of hours, and eventually got sick. So I think it's a cautionary tale. And there is that, I think there's that natural sort of decision you need to make. It's probably somewhere in the 10 to 20 employee range, where you're like, okay, I built something, probably got a little bit of value. I could sell it, or certainly probably bring it, sell it to a private equity group and continue to own it, and let someone else sort of help me scale to the next, to the 40, 50, 60 employees. Or I could probably just sit here at 10 or 15 employees and plateau and just have a lifestyle business. Or I could swallow hard and make the changes needed, knowing that in the short term, I'm probably going to take a hit on profitability, and just kind of suck it up and know that that's likely to be the outcome, and know that on the other side of the kind of chasm, if you will, there is a rainbow. And so in John's case, he kind of didn't do that. He got to 30 employees, but didn't hire the team. And I wrote an article about it after I did the interview, and I kind of used the parallel of the Tour de France. Are you a bike racer at all, Jeremy? Like, do you know anything about the Tour de France? Do you follow that at all?
Not really.
Not really.
Besides,
Tour de France.
I've listened to interviews with Lance Armstrong before.
Oh yeah,
so
okay.
I know a bit, but yes.
Well, I love
I just
watching
know I would never want to do it because it sounds like grueling. But yeah.
Yeah. I had the opportunity to actually do a stage of the tour. It's called
Oh, wow.
it's a bike race, amateur bike race called the 𝙁𝙊𝙇𝙊𝙊𝙀 Tour. It literally translates to a stage of the tour. I did one, and it was like 210 kilometers through the Pyrenees, and it was like epically hard. But it's
Right.
given me an incredible sort of appreciation for what these athletes do. And if you know anything about cycling, when they go up a mountain, the resistance, like the wind resistance they encounter is like very, very minimal. Because they're not going in a peloton down a flat. But even just going a little bit out of the peloton when they're climbing is just enough energy release to make it harder for them. And so these guys climb, and the way they do it is the top climbers will sprint ahead, and within sort of 5 or 10
Mm.
yards, they'll get sucked back into the peloton. And the question a layperson would ask is like, why on earth do they do that? Like, why do they sprint ahead if they're only going to be caught just 5 or 10 yards later? And the reason they do it is they're effectively tenderizing their opponent. Every time they sprint ahead, that peloton has to dig deeper in order to bridge the gap. And every time they do that, they go into VO2 max overload or whatever it is, and they reach a point where they can only just hold on. And so after 5 or 7 or 10 sprints ahead, finally the peloton can't bridge the gap, can't make it because they've been tenderized. And so I use that analogy in this article because for John, he had gone through a tenderization, this medical event where it made him much more likely to sell his company, and to sell it not necessarily for the highest possible valuation. He was really keen and sort of motivated to get out. So what he did is sold it. He sold 70% of the company and carried 30% of his equity into a new entity. And so what does he do? He puts money in his jeans, just like Ben Kelly, but he's got a little bit of skin in the game, but he doesn't have the stress of running his company anymore. And so now he's got a business development role. He knows he doesn't have to work again, technically, or at least for a long time. So he's got that sense of freedom associated with having some financial independence. And he's got the stress relief of not running the company day to day. At the same time, he's still got some skin in the game if they're able to kind of continue to grow it. So I think it sounds like an advertisement for private equity. I don't mean it to be that way, but in both Ben and John's case, it was right for them in the stage of their lives that they found themselves in. One for wanting to kind of solidify their family financial situation, but in John's case, it was more of a medical requirement. So I think hopefully, when our next conversation, Jeremy, we won't have to talk about COVID so much. But I do think over the last 2 years, this pandemic has tenderized a lot of business owners, right? Like there's a lot of businesses out there that, I mean, in particular, anything dealing with the public, direct to consumer, obviously consulting, restaurants, anything where you have a consumer facing role, they've been devastated. And it's been just incredibly stressful to go through this sort of like roller coaster that is the pandemic. And so I think what we're finding is that there are a lot of business owners now who have been tenderized to the point where they're like, yeah, I might not get what I thought I was going to get 2 years ago, or what my buddy got for his business, but for me right now in my stage, I can't stress about it anymore. And I think there's a lot of that out there right now.
Yeah. So we have a question from Anne, and she said, when I sold my small business for its assets to my largest competitor, I took a 4-year earnout based on a minimum purchase price. Unfortunately, there was no growth over the years, and my acquirer went out of business. On top of the agreed upon minimum purchase price, I kept my positive working capital. Could this working capital amount be considered in the overall purchase price? And then she kind of goes on to say, I was dissatisfied with the ultimate minimum purchase price I received, but if I factor in being able to keep the working capital, that makes what came out within my genes actually more appealing.
And I don't mean to dodge your question, but this probably is technical enough and has enough kind of moving parts associated with it that you really probably want to get a professional legal opinion on that. I don't want to tell you something and have you go off and use it as gospel. And I think there's just too much at stake for you personally in this deal. So look, working capital, for those of you, and this is maybe taking it up a little bit more generally, is the second most important number to think about in any agreement to sell your company. Of course, the most important number is the valuation on the deal and what you are going to be paid for your company. But there is this very important second number in most term sheets, most stock share purchase agreements, which is basically how much cash you need to leave in the company the day you hand over the keys. And getting really clear with an acquirer about that is important, because for a lot of small businesses, and Ann, you may have done this for years, we run our companies profitably. We're not in a hurry to pay taxes, any more taxes than we need to, and so we just keep it as retained earnings in our company, right? And that retained earnings pot of honey becomes our sort of our rainy day fund, and it becomes just cash that we have in the business. Now, you may take the view, well, that's money I've earned over the years. I've made profit, and therefore that's my money to scrape out of my company before I go to sell it. That you may be able to make that case to an acquirer. An acquirer may take the view, well, that's the working capital. It's in the business. It was in the business when we looked at it. It was in the business when we valued the company. So it needs to stay in the business when you pass over the keys to us. That's an area of interpretation that needs to be worked out well in advance of you agreeing to any letter of intent. And so being clear what that working capital calculation is at the time of transaction is going to be very important. It may have big downstream impacts for the ultimate take home of selling your company. So again, and specifically, I'd seek legal advice on your specific issue, but anybody listening who is sort of entertaining a letter of intent or any sort of offer, I think what you're really going to want to zero in on is that working capital calculation. And if it's not defined, if it's not being clearly stated, that's a bit of a red flag as well, because it suggests that the acquirer is using a fairly superficial or vague letter of intent to lock you in. Most letters of intent, as we've talked about before in the show, have a no shop clause where you can't negotiate with another company while you complete due diligence with the acquiring potential acquirer. They have the rights to walk away, but you don't have the rights to negotiate with anybody else. And so if you agree to a letter of intent, you give up your negotiating leverage before solidifying your working capital agreement. That can be just a recipe for undermining your negotiating leverage to get that working capital agreement sorted out. So again, if it's vague or it's like, oh, we'll think about that later, I would say no. Let's figure it out now. Let's come up with a formula. Let's agree now what that's going to be. So I think that's just more information on the working capital calculation, which again is the second most important number in any LOI.
That's valuable to know, John. Do you find that there is a range, like we want to keep do they usually say, I want to keep 1 to 2 months, or I want to keep 1 month? How do they end up figuring out what that is? Because I could see if I'm selling, I don't want to be the bank account at zero. I want to be able to fund some, months. But is there a range?
Yeah, it depends a little bit on the size of the company. Like a very small company will usually be sold on a debt-free, cash-free basis. So like you're going to hand it over to us without any debt, and at the same time you can strip out all the cash. That's a pretty common for a retail type of small company. In a larger company, it's often a percentage of AR. So, especially in a B2B business where there may be hundreds of thousands, millions of dollars in accounts receivable, when you hand over your company, you're like, those are sales I've made. We sent an invoice, but because I sent the invoice to GE or IBM, they're going to pay me in 90 days. Well, I need that money. And then you can get into a discussion around like what working effort needs to be put into that invoice, that contract, that account during that time. How much of that have we already paid and done? And so oftentimes that'll come down to like a percentage of AR. But it's less important to agree to any one formula. It's more important to make sure the formula is clear to both parties, that you all agree it's either cash-free, debt-free, or there's some working capital formula that you've agreed to. So it's not, it's not subjective. It's not something you're trying to figure out 3 days before close.
Ann says, thank you. That helps. This has been great. I just want to encourage everyone, go to Built to Sell, sign up for the newsletter as you can get on the webinar, and please ask all the questions. That's what we're here for the live. And you could check out all episodes of builttosell.com on builttosell.com/radio, or if you want to check out, that John mentioned a few times about the SOPs, you can go to builttosell.com/SOP and check out their ebook. John, any other places we should point people towards or mention?
No, all roads just lead to Built to Sell. So yeah, builttosell.com. I think there's a button that says free gifts. If you download those, you'll be opted in to receive invitations to the live show, and you can ask any questions you want. It's been great. So Malcolm, Susan, Ann, I can't remember who else asked questions, but I hope they were helpful. As always, Jeremy, I'm grateful for you being my co-pilot here and hosting as always. So thank you for doing it.
Great. We'll see you next time.
We will see you all soon. Take care.
Built to Sell Radio is produced by Haley Parkhill. Our audio and video engineer is Dennis Labataglia. If you like what you've just heard, subscribe to get a new episode delivered to your inbox each week. Just go to builttosell.com.